There's huge growth to be seen from the EVs transition and the renewable energy build-outs globally. But this is growth that will emerge over the next 5 to 10 years. It's not something that's happening overnight.
Hello, and welcome to another one-to-one Mining Investment APAC online content session. Today, to look at China's commodities outlook and the energy transition, we have Ian Roper, General Manager at Shanghai Metals Markets Singapore.
Thank you very much, just one-to-one, for inviting me to speak today. I'm going to talk to you about the commodities and the energy transition. And while that's a good long-term structural story, I think with prices at record levels already for many commodities, there's a big question mark of, is all the good news already priced in? So commodities this year have certainly seen some exceptional price performance, driven in large part by global macro flows, right? Predominantly, the speculative capital has been more Western driven than Chinese driven. It's related to the global reflation trade, dollar weakness, money printing, a lot of reasons why there's been a lot of money flooding into the commodity space, coming and going in waves, especially the CTA trading, as we see on the LME net length positioning. But when we look at commodities as a fundamental perspective, as a fundamental analyst looking at the sector for 20 years, this has been the first time that the fundamentals have not been very helpful in making any price forecasts, especially on the China side. For the last 20 years, if you get China right in commodities, generally you get the whole picture right. This year, last year, that's not really been the case. So I know there's been a lot of attention recently, China not the marginal buyer of commodities. I would say that is only a cyclical story, not a structural story. It's just that right now, China is clearly slowing, with Beijing having tapped the brakes since Q4 last year. We have a 2% fiscal drag. We have 1.1 trillion less special bond issuance, so less infrastructure spending. And that is having an impact. All the demand indicators we see sequentially onshore are clearly slowing. But of course, base effect from Q1 into April last year, because of the low base effect, we've got astronomically high annual growth numbers. And that's capturing a lot of the attention and making people think demand is still strong. But if we look deeper at the data on a sequential basis, Chinese commodity consumption clearly weaker than it was in Q4 and still very much on a slowing trajectory. So when we look top down at the metal space today, there's no real structural shortage of any commodity. This is not like the boom markets of the 2000s or 2010-11, when Chinese demand was booming and material was really very tight, and in many instances LME inventories were running out, and that's what was causing high prices. This time that is not the case within the physical markets. There's plenty of metal around on a top-down global view. The issue is that we have a lot of pockets of regional tightness, predominantly driven by restocking, right? This is the global phenomenon. That's why I say this situation is only temporary. We're in the midst of the greatest global restocking cycle we've ever seen. Right? Global growth was essentially paused for a large part of 2020, and now that is catching up. People have fallen behind the curve. Everyone is scrambling to get more supply. And the big issue is that the logistics cannot handle it. So container rates obviously extremely high right now, but metals in particular struggling to get moved in many locations. So that's why you've got very high physical premiums in places like Japan or the US, big importers of materials like aluminium and copper, because that material is just physically very hard to move into those markets. So there's no structural shortage of the metal on a global basis, but getting it to customers at the moment has proven very tricky. And that's why we have these pockets of tightness in many markets, giving the illusion that markets overall are tight, when in fact that's not really the case. So it's these pockets of tightness combined with the macro flows, all of the fast money chasing the dollar depreciation, global reflation trade. That is what is causing the high prices. There's very little in the way of fundamental support behind that. Of course, recently we've seen Beijing getting worried about inflation, trying to cool commodity markets. But again, this is an unusual cycle. Right? This is not the 2000s. It's not 2010-11. China is not the driver. It's not the booming Chinese demand. It's causing the high prices. So from that perspective, Beijing has limited power to control these prices because they are driven more by ex-China macro flows, ex-China tightness. And from that respect, there's very little that Beijing can really do to bring prices down structurally here. So that's the top-down view. I'm going to run mainly through the energy transition commodities today. So we'll look at copper, and then we'll look across the new energy space. So on copper, a lot of excitement around copper, prices at record highs, and a lot of people pushing the structural thematic of the energy transition. There's not going to be enough copper supply. Copper is going to be a very tight market. Yes, in the long term, I agree the demand story looks extremely strong and the supply story is more questionable. Will mines get built in time? It's not like we're ever going to run out of copper. There is plenty of copper in the Earth's crust. It's just deeper underground, harder to operate environments. So newer projects are increasingly expensive. And of course, for the last 5 years, major mining companies have predominantly been returning capital to shareholders, not spending so much on big new investments. Of course, if this thesis on global structural growth thematic around not copper supply being clearly in shortage later in the decade, if that filters through to mining management decisions, we could easily see the miners trigger a lot of big investments that could actually fill that gap for the late 2020s if they start to move soon. So that's going to be an important part of the story to see if any of the majors do start moving on some of the mega projects that they could potentially do. Outside of that longer term story, though, in the shorter term, the copper market does not feel that tight at all. And especially for this year and next year, I think the copper market will be in surplus. So from the mine supply side of things, absolutely, there's a lot of tightness in the copper market today. TC is extremely low levels. We've had ongoing issues, Peru, Chile, the virus, disruption continuing in those countries, political issues, strikes, elections, etc., causing plenty of other problems. So the mine supply side of copper still looks very, very tight indeed. But from the physical metal side of things, we just don't see that tightness reflected in any of the normal indicators. Physical inventory is rising. Physical premiums in China are at record lows. The demand indicators in China are not good. And part of the reason why we have sufficient metal when we don't have enough concentrates is that the scrap supply is surging in response to these high prices. And that's something that often gets overlooked in the copper market. So the mine supply numbers, everyone focuses on those, but scrap supply is also very, very important. In the early 2010s, last time copper was anywhere near these price levels, global scrap supply was about 4.5 million tons a year. Last year, it was down to barely 2.5 million tons a year. With the prices surging again, of course, Western world last year, lockdowns, very low prices, scrap collection and generation rates were quite subdued. With the high prices we're seeing now, those scrap collection rates are absolutely surging. And of course, on the Chinese side, they, after 2 years of banning most of the copper scrap imports, they reclassified the scrap into secondary material imports. So high quality scrap is now allowed back into China. And we've seen those import volumes surging. So 150,000 tons a month last couple of months, up from 70,000 a month last year. So I was expecting at the start of the year scrap supply in China to rise about 500,000 tons. It increasingly looks like it's more like 700,000 or 800,000 for this year. And that is what is providing enough copper units for the smelters to keep producing enough copper to meet the demand. So smelter output, it certainly is being constrained by the concentrate supply to a degree, but the increased scrap availability is certainly helping to allow the smelters to meet the demand. And on that demand side of things, again, a lot of the indicators not so strong. Electronics, appliances doing very well, especially on our PMI data, but other end-use indicators clearly say end copper demand is not doing that well at the moment. It's clearly a bit softer than it was in the fourth quarter. Physical premiums, as I said, at record lows. Physical inventory has been rising. Now, partly this is offset with end-user destocking of copper. We do think end users built about 300,000 tons of inventory last year. So to some degree, that's being destocked today. But overall, the fact we've got rising copper inventory, not only onshore in China, but globally over the last few months, says that the market clearly is not a deficit market for this year. And as the mine supply recovers back end of the year into next year, that should then ensure sufficient supply as well. So for the near term, I do think copper markets are oversupplied. Prices are probably too elevated versus the fundamentals. But that is very much a macro decision on the prices. If the dollar reverses course and starts strengthening, if people start to worry about global growth, copper could have a long way to fall. but the pricing action has been predominantly driven by macro since 4Q last year, and I do think that will continue to be the driver in the near term, even as the fundamentals continue to weaken. So just coming back to the longer term story on copper, there's huge growth to be seen from the EVs transition and the renewable energy build outs globally. But this is growth that will emerge over the next 5 to 10 years. It's not something that's happening overnight. So for China as a whole, 12 million ton copper market, we think the incremental copper consumption in both the EV sector and the renewable energy sector is only contributing an additional 60,000 tons of copper demand this year, versus that scrap supply up 600,000-700,000 tons, other supply as well coming in. So the structural story for the medium and longer term may be sound, but it's not a game changer for the short term. The short term, the prices absolutely have been driven by macro and will continue to be so in the coming months. So moving on to the other battery materials. Again, battery materials have done extremely well. Now, they were more fundamentally driven through the second half of last year. Obviously, Chinese EV sales doing very well, Western world EV sales then kicking in later in the year and so far this year. So there has been very good demand growth, undoubtedly. That triggered a lot of inventory building at the Chinese battery plants. But the ultimate problem we have across the battery space is that the Chinese, as always, have just built enormous battery processing capacity. So the average utilization rates across the supply chain through the battery processors, the battery manufacturers, average utilization rates there, 50-60% at best. And that means that no one has any pricing power. They've not been able to pass through the higher prices of these commodities, and that's what's ultimately leading to some weakness. So one of the big issues in the battery space, of course, is the technology. Which technology is going to work out to be superior and take the largest share? A lot of debate about that in the markets, but what we're seeing in China certainly is that the LFP technology is certainly good enough to dominate in the lower end vehicles, the budget vehicles, where people are more conscious of the cost than the performance. So LFP batteries in China consistently getting 400 plus kilometers range, decent enough reliability, still some issues with the cold weather power draw, but otherwise they are good enough to be viable for certainly the budget vehicles into the mid-end. Whereas the nickel batteries, yes, technologically superior, more power, more range, but of course more costly. So they may well dominate in the higher end vehicle space, but certainly not in the budget end, especially not in China. So globally, the EV market looks increasingly to be going towards the nickel batteries, but the Chinese increasingly going to the LFP batteries in that budget mid-end sector. And I think ultimately the world will follow that trend as well. So given versus last year, we have actually downgraded some of our nickel demand forecast numbers on this change. And then for other materials, of course, lithium hydroxide predominantly going into the higher grade batteries, so not so good for that structurally, whereas the carbonate side of things in the LFPs, that perhaps has a slightly stronger outlook. So in terms of nickel, where prices are today, obviously nickel price is still dominated by stainless steel. That looks like a very negative outlook for nickel, given the surging NPI production out of Indonesia. But even the battery sector for nickel is oversupplied for this year as well. Nickel sulfate supply in China absolutely surging at the moment, over 100% year to date, even faster than the demand growth. So we don't see the nickel sulfate market in oversupply this year. We don't see that it should justifiably go to a huge premium over the NPI prices. And ultimately, with all the NPI surging out of Indonesia looking at running up to 1 million tons of NPI at the moment versus 600,000 last year. Clearly, the NPI stainless side of things is going to be coming under pressure in China in the second half of the year. That ultimately is likely to push nickel further and nickel lower without enough tightness in sulfate to really cause a major bifurcation in the prices this year. On the lithium side of things, lithium carbonate supply has been responding to the higher prices since Q4 last year. Certainly in Western China, we're seeing the brine supply surging. So that inventory draw that we saw in carbonate back end of last year when demand was surging, people were ramping up facilities, chasing more material, building inventory at the processors. That kind of excitement in the market has now largely passed, and lithium carbonate prices therefore starting to roll over. But of course, the interesting thing last year was how carbonate started rallying, but hydroxide got left behind. Now, of course, carbonate is mostly domestically consumed in China, whereas the hydroxide, nearly half of China's hydroxide consumption is ultimately exported. So that demand recovery lagged the carbonate recovery last year. It's been kicking in a bigger way since the start of this year. And that's why hydroxide prices have been rallying harder since the start of this year. Of course, structurally, once hydroxide is back at a premium to carbonate of about 10 to 15,000 RMB a ton, we could see switching from carbonate into hydroxide, processing to upgrade it. So that will essentially cap the upside to hydroxide. And overall, for both lithium products, we don't see a structural shortage in those until 2023 at the earliest. There is plenty of supply growth. There is plenty of supply switching on and coming back, stuff that was mothballed with the low prices from 1920. So we do see the lithium market being comfortably supplied on a 1 to 2 year horizon. Cobalt as well, we've already seen cobalt prices rolling over. That's again, as the supply is quite sufficient to meet the demand. And the big issue, as I said earlier, is that just the battery processors just don't have any pricing power. They were not able to pass through those higher battery material costs. And that's why the traders and people who were pushing up the offers previously had to adjust them to lower levels. Similar story in rare earths as well. We've been seeing rare earth prices coming off to a similar degree, given that supply again is sufficient, especially with the quota cap being lifted in China. And the battery processors just could not pass through the price rally that we'd seen over the end of last year, start of this year. Longer term, of course, there's still plenty of solid demand growth with the battery story. Still big believers that the EV share in China will be significant. Of course, latest 5-year plan, NPC meetings, Beijing's still sticking with the targets for 2025, 2030. The penetration on EVs should be over 20% by 2025, and it's probably going to be towards 50% or higher by 2030. But even with that solid demand outlook, strong demand ex-China, the issue we face is there is just plentiful supply of these battery materials on a 2-year view. So given the prices acceleration that we've already seen, we do think prices from here next 1 year or so could be softer. Looking a bit further ahead on the 5-year planning side of things, the 5-year plan doesn't look so good for commodities like steel in terms of less infrastructure build out, less housing construction. But for things like copper is the clear beneficiary of the 14th 5-year plan. So yeah, on the construction side of things, it's likely we'll see a much slower construction market in the coming 5 years in China, not only from the demographic side of things, slowing pace of urbanization, but also less policy support. We no longer have the shanty house construction program. Back in 2016 to 18 period, that was up to 20% of all of China's housing construction. That program is now finished. It's been replaced by what they call the upgrading old communities. But whereas a shanty house was demolishing very old buildings and putting up new high-rise buildings, the old community upgrading is more about just giving a facelift to the buildings from the 1990s, early 2000s. So that's not really demolition and new construction. It's more just giving a facelift. So perhaps good for copper and aluminium if there's new windows and doors, rewiring and stuff. But it doesn't mean new construction activities are not so good for steel. On the infrastructure side, again, China's done an awful lot of infrastructure over the last decade plus, and it is now looking to slow that down. For instance, on high-speed rail, China added 20,000 kilometers of high-speed rail between 2015 and 2020, and the plan for the next 5 years is to only add another 10,500. So essentially half the pace of the high-speed rail build-out. So that's quite a negative for things like steel consumption. But there are other good news stories though. So subways, for example, accelerating. Last 5 years, China built about 4,200 kilometers of subway lines. Next 5 years, going to build 5,300 kilometers. And subways, of course, a lot more commodity intensive given the tunneling infrastructure and more stations on a per kilometer basis as well. But the big story for copper, of course, is the energy transition. China will certainly be investing a lot of money in that. Doesn't mean coal is disappearing. You know, a lot of commentary to that degree. China, in fact, the 5-year plan for coal still allows coal production to rise 200 million tons over the next 5 years. So coal will be displaced as a percentage of total power output. Absolutely huge growth in renewables, in wind and solar, very supportive for copper, but coal will not be displaced over the next 5, even 10 years in absolute tonnage terms. So that's it from me. I hope that's been a useful overview of where we stand on the copper and new energy markets. Essentially, yeah, all of the good news for now is in the pricing, but of course there are very good long-term structural stories. We just think the prices, with all the global reflation, dollar weakness, all of the speculative overlay, prices are probably just overshot for now. And there's my contact details if you want to reach out to find out more about what we do at SMM. And thank you very much for listening.